My name is John McInerney. I'm the chair of the Leeds Bradford local group here. So you're all very welcome, everybody at home, but then also obviously in the room where we're enjoying tea, coffee, biscuits, and a bit of fruit. We are doing these hybrid events all through this year after a bit of a hiatus doing the online only. So do feel free to come in and talk to people and meet people, because the idea is hopefully that we'll put on these sessions and they won't just be about pouring information into you. They'll actually be about having discussions that could create some new ideas and hopefully some new connections. I know I've already spoken to 2 people today, and that will hopefully lead to some talks in the future. So I am going to introduce today's session, but today's session will actually be hosted by our committee member, Celine, who will, you'll hear her voice soon in about half an hour when she deals with questions from everything. But first, let's go over some absolute basics. For the people in the room, it seems pretty obvious. The door's there. It's the only exit on the way out. Go straight down the stairs. No major announcements for this week. I know last week you had 1 or 2. All I want to say is that we've a bunch of events that we are planning. We don't have fixed dates for them yet for the rest of the year, but they will be coming soon, and you're going to find out about them either by signing up for the newsletter for the local group, or just go on to the rss.org.uk website and go to the training/events page. You don't need to be a member for this. You don't need to be logged in for this. Just check out the various things that are going on. As you can see, I've just highlighted there on the top right today's event, but there's loads of others happening there as well. I did hear earlier on today that when some people are registering events, it starts saying about paying for this, that, or the other. Don't worry, just read the kind of print a bit carefully. It's probably just asking if you want to become a member of the Royal Statistical Society and a fellow. That will involve paying. None of our events are going to be paid for events, so you can always just turn up to them whenever you like. Without further ado, we have 2 speakers today. We're going to have speaker for about 25 minutes, half an hour-ish, I believe. Then we're going to have a little bit of break, maybe some questions, and then we'll have our second speaker. So first up, we have the wonderful Joanne, who's going to talk to us about what's on the screen there. And of course, Joanne joins us from Leeds Building Society. After the break, we'll have Thomas and Healy talking to us from Foremost. So what I'm going to do now is I will stop sharing this particular screen. Oh, one final thing to note, I almost forgot. We are recording the session for hosting on our YouTube playlist, particularly for those at home. If you don't want to be seen, then turn off your camera, because the way Teams records things, it records the whole Teams window itself. When it comes to questions, I suggest if you have them as the time is going on, throw them in the chat. That way our speaker can have a look at them and then ask you to unmute yourself to ask the questions later on. Hopefully that is clear as mud. The next thing I'm going to share are Joanne's slides. And I'm just checking my laptop.
They're not mine.
Oh, they're not yours at all. This is why we check these things. So you are these ones.
That's it, yes.
And let me also just make sure that we're sharing the whole thing. I can see on my laptop we have the right thing being shared. Okay, over
Fantastic.
to you.
Thank you. Okay, so I'm just going to talk about the IFRS 9 models that we have at Leeds Building Society. So I'm going to, first of all, just a little bit of background as to what IFRS 9 is for those of you that aren't familiar to it, and then the suite of models that we have that feed into calculation of IFRS 9, and that some of the models are a little bit more interesting than others. So I'm going to then focus in a little bit more detail on a couple of the models that feed into the suite. Okay, so first of all, just some background on what IFRS 9 is. So banks basically have to provision for what they think their losses will be, and in 2018 we moved to IFRS 9, which basically means that rather than having provisions that reflect when there's already evidence of poor performance, it's on an expected loss basis. So we kind of model on a lifetime basis, so what we expect the loss of an account to be over its lifetime. So it may not have any evidence of any issues currently, but it may have in the future. So that was the change in IFRS 9. So, and then because IFRS 9 is on a lifetime basis and we need to use forecasted information, that means there's lots of scope for much more advanced modelling than there previously was under the old approach. So provisioned aren't entirely the models, but models are a substantial input into the provisioning. So under IFRS 9, what we actually calculate is expected credit loss, which is the amount we expect to lose over the lifetime of the account from when we observe it that month to its contractual maturity date. And because IFRS 9 requires us to use forward-looking information, we have forecasted economic data which feeds into the models, and I'll come into some of the details of that as we work through. So obviously every organisation's models are different, how they all interact. So at Leeds Building Society, it's quite a complex suite of models that we have. Some of the models within that suite are very sort of basic, probably simple summary statistics. We have some sort of industry standard logistic regression models. We've got econometric modelling, survival models, and random forest models. And the latter two of those is what I'm going to talk in a little bit more detail about. So sort of talked about what IFRS 9 is, and mentioned that we need to calculate expected credit loss for each account. So basically, expected credit loss is just the EAD times the PD times the LGD, and I'll talk about what they each are in a second. But as well as calculate, we don't just calculate it for each account. So for each account, every month we calculate ECL, we calculate it for the current month and for all the future months that the account is expected to be on book. So if someone's expected to be on book for another 25 years, say, we'll calculate the ECL at each of those single months right up for the next 25 years. There's obviously a lot of data. So within each of these EAD, PD and LGD, there's a lot of submodels, which again I'll go on to in later slides, but just at a sort of high summary level, EAD, exposure at default, so it's what we estimate the balance will be at the month of default. So because we calculate it at future months, so obviously at your observation month, you know what the balance is, but you estimate what your balance will be at month 10, month 20, etc., all the way through to 25 years if they've got 25 years remaining. And then PD is a probability of defaulting in each of those future months, and LGD is the loss that we estimate will occur if the account defaulted in each of those future months. So that's the three main building blocks of ECL. The one that's most complex statistically is probably the PD, so I'm going to focus more on that one today. So as well as calculating ECL for every account, every month, for the current month and all future months, as well as that, we also have to calculate it under a range of economic scenarios. So we have a number of economic forecasted inputs, things like unemployment, what we forecast unemployment will be over the next, over the lifetime of the account, GDP, house prices, and a number of economic inputs. And we have each scenario will have let's say, a downturn scenario, what we're predicting house price falls will look like over the next sort of 10, 20 years. And they'll have what we expect GDP to look like, etc. So each scenario will have a different set of economic inputs. So we calculate ECL under each of those scenarios, and we use those in combination to calculate overall ECL. So again, even more data. So I mentioned that we calculate ECL over a lifetime basis. It's not entirely strictly true for all accounts. So what we have to do for each account is allocate it to a stage. So either it's currently in default, where default, it means it's either 3 months down, or it's hit various unlikely to pay triggers, usually that it's had some type of forbearance, capitalisation, or something along those lines. We have a sort of a formal definition of that. So if it's hit one of those criteria, it's in stage 3. If it's not, it could be in stage 1 or stage 2. And that what stage 1 and stage 2 is, it's how how PD has deteriorated from when it was originated. So if your PD, so if your probability of default is the same as when you was originated, you would be in stage 1. If it's deteriorated more than a certain threshold, you'd be in stage 2. And what the difference that makes is if you're in stage 1, we only need to calculate ECL over the next 12 months of your lifetime, not your full lifetime. For stage 2 and stage 3, we calculate it over the whole lifetime. And then for each account, to get its overall ECL, we'll do a weighted average of the scenarios. That's a sort of conceptual overview of ECL for those of you that aren't familiar with IFRS 9 and ECL. So now move on to some of the details of the models. So this slightly colourful slide is a summary of all the models in our model suite for IFRS 9 at Leeds Building Society. So you can see in the big yellow circle there that the PD suite is the most complex. So the main model we have in there is a survival model. So this predicts the probability of default in the next month, conditional on it not being in default and actually being on book the month before. To calculate that, and again, I'm going to talk in more detail about that particular model, but what feeds into that model then is we have just some straightforward internal data, which is in the green box on the bottom left there. So months in arrears, months on book, LTV, etc. We also have one of our capital models feeds into this as well. So that's a ordinary logistic regression model that predicts probability of default in the next 12 months. And then we have an econometric model also that feeds into the model. So this predicts 3 months down in 3 months, but it uses econometric inputs, which, as I talked about in the previous slide, we calculate it under a range of scenarios. So you're to get a different answer in each scenario. So that is an input into the survival model. And then, so the survival model gives us this condition, what we call a conditional probability of default. And then to get the PD that feeds into our ECL, we also have a redemption model. So this predicts the probability of redeeming in each of the future months. And for that, we use a random forest model. And again, I'll talk in a little bit more detail on that in a second. So all those models in combination then give us this monthly, so forward-looking PDs that go over for each account every month. We have a probability of defaulting each of the future months, and that feeds in with the LGD and EAD calculations to calculate ECL. So I talked about the different scenarios and the different economics. This diagram here really just shows you the sort of types of economics and how they feed into each of the models. The only model we have that isn't impacted by the forward-looking economics is the EAD model. The econometric model, which I mentioned was an input into the conditional PD model, has GDP, base rate, unemployment, house prices as inputs. And then the LGD model uses HPI as an input in numerous places in the model. We predict what the sale price will be at the point that they go into default, if they default in the future, etc. So all the ECL calculations that we have are all dependent on the forecasted economics. So that's the sort of talk about what IFRS 9 is, what the sort of suite of models that we have that feeds into that calculation. Now talk a little bit about a couple of the models. So the first one is the random forest model, which is the one that predicts the probability of redemption in each of the future months. So it's again account level model for every account, for every future month that they're expected to be on book. What's the probability of them redeeming? And then we use the outputs of that in conjunction with the outputs of the survival model to give our probabilities. So The random forest is quite a new model for us at Leeds Building Society. We only implemented it last year. Previously, we used to do this with a series of logistic models. We had about 60 or 70 logistic models running, one after the other, based on sort of random seeds as to which model you fell in. So it worked great. It was really accurate. But it took days to run. So we moved to the random forest model as a means of getting a similar level of accuracy, but without so we could actually run it and not fill our server up so much. So now talk about the random forest model and just a sort of slightly dumbed down version of model here to explain the concept. So a random forest model is essentially a group of decision trees. So this first slide here is just what a decision tree is, which may be familiar to a number of you. So there's an example here. It's a series of questions with answers. So if the first question is your balance less than 50,000, and the answer to that is yes, then your probability of redemption is 20%. If it's no, then you ask another question. Is the account going to mature next month, yes or no? And you follow the tree down. So if your balance is more than 50,000, you're not going to mature next month, and your market rate is less than your product transfer rate, then your probability of redemption is 20%. So that's what a decision tree is. So then moving on to the random forest, so that's a collection of decision trees, and it gives a much more accurate prediction than a single tree. So the example we've got at the bottom here is a simplified example where there's 3 different trees are created. So tree 1 would give a probability of 20%, tree 2 25%, tree 3 19%, and then our overall probability if there was only 3 trees would be the average of those. So that's the concept of a random forest model. So we developed the random forest model in SAS. We have also done it in Python as well. The Python models gives a lot more flexibility, but the SAS one works fine too. So basically, on the random forest model, what it does, it creates a training sample, a holdout sample, and to create each branch of each tree, which is done automatically by the algorithm. It randomly selects 2 variables, takes the one with the most power, and then uses the algorithm to determine the best split, and keeps going down the tree till it reaches the end, subject to the constraints that you give the tree. So we constrain the number of trees, we constrain the depth of the tree, and that's part of the modelling to do that. So the example that we've got here, figure 3, shows that this particular tree would it would randomly choose balance and LTV, which are 2 of the sort of 2 of the key characteristics that we put into the model. It selects the most predictive one as being balance less than 50k, and then the next split would be, the next predictive ones would be, it would say market rate and time to maturity, which are randomly chosen. It predicted the most predictive one of those 2, which is the market rate less than 3%. And it would do this separately for each individual tree. So the particular model of the random forest model, we've got at Leeds Building Society, we've got 3 different segments reflecting the different performance of accounts at different stages of their product. So we've got models for if they're on a fixed term product, if they've actually just reached maturity, or actually at the month before maturity, or if they're on a variable rate, because we'd expect their redemption probabilities to be different depending on which of those they're in. And the little green bit at the bottom shows you all the potential input variables. This is not quite a full list of them, but this is the sort of some of the key ones that we feed into the redemption model. So how long they've got to product maturity, what's their lending segment, have they been retained before? So if they've previously been on one product and then joined another product, they have a different redemption probability to someone that we've never retained before. if they've got an early redemption charge, how long they've been on SVR, and the difference between the interest rate, so the customer's interest rate and the market rate. So again, the market rates are a forecasted value. So they're the sort of drivers. That's our segmentation. As I mentioned before, I think the key benefit for us of building this type of model was that it's as predictive as our previous set of models, that it runs in 2 hours rather than, well, I say 15 hours there, that's 15 hours on a good day. It could be 3 days. So it's a real benefit for us there. And it's nice to get this type of machine learning type of model to be used. I think we build capital models as well, where we're under a few more constraints. What the PRA will allow us to do on the IFRS 9 side, we've got a little bit more flexibility. So as long as we can prove to our auditors that these models are effective and do what they're meant to do, we're free to choose the methodology. So it's nice to be able to do this sort of modelling. So that's it on the random forest model, which, as I mentioned before, gives us a probability of redemption, which feeds into our overall PD calculation. The other model that feeds into our overall PD calculation is the survival model. So this gives us the probability of default in every future month, given that you're on book and not in default in the month before. So it uses a range of sort of historic and sort of actual data at the point of observation, as well as all the forecasted data. And it also uses the outputs of the economic model as an input as well. So because for IFRS 9 we need to calculate PD over the lifetime of the account, which I've talked about before, a survival model is the ideal model to do this, because it gives us that time-based element of it, which is what we want. We don't want to know just, are you going to default in the next 12 months like we would for an IRB capital model. We want to know what your probability of defaulting in all these future months over this contractual lifetime is. Because it's mortgage data, it's month-end data, so then the natural model is a discrete time survival model. So again, we build this in SAS using a logistic procedure, and what we structure the data in such a way that gives it that time-based element. Otherwise, it's just like running any other logistic model. So we build the data. We use a lot of data to build this model. So we've got data going back to 2006. So we build it on our full data series, including benign conditions and the downturn conditions in 08, 09. And obviously excluding COVID data, which is we don't expect to be typical. So we use an awful lot of data that feeds into the model. Survival models don't have an outcome period, so we can use the complete data set, and then we structure the data. So for every single account, we look at that account and its observation month, and then we look at all its future months as the performance months and structure that. So you can imagine that gives us absolutely huge data sets and these quite big server resources to do. But that's really the only downside of this sort of model. And then your outcome variable is just simply, does it default or not in the next single month? So this slide gives us the data that feeds into that survival model. So as I mentioned previously, we have a separate macroeconomic model, which is a logistic regression model that uses just economic variables as an input, and then gives us an output, and we feed that directly into the model. The benefits of having the economic data not in the PD model and outside, it gives a little bit more flexibility. So like in the current situation where probably coming into a different type of downturn to previously, it gives us the option to put some adjustments in that model without actually going through the hassle of rebuilding the whole PD model. So it works quite flexibly and nicely. So as well as that macroeconomic output from the macroeconomic model. We've got a number of what we call static variables. So these are the ones we observe at the observation month, and they don't change in the future. So your lending segment, or your months in arrears, or whether you pay a capital repayment or interest only type of mortgage, etc., that type of thing, as well as when I say the risk score, we were using a version of the IRB PD score for that. So those variables don't change over the future lifetime of the account. And then we have other variables that do change over the future lifetime of the account. So obviously time on book. So if you're 25, if you're 10 years on book at observation, you're 10 years and one month, 1 month later, and that will kind of be calculated. LTV we estimate using the forecasted HPI, and we assume the sort of standard amortization of the accounts. If you're a capital repayment type, we know your balance will reduce, so we calculate that. So the model takes all of those things as an input to give us these future monthly probabilities. So that's really it on the PD model. So there's PD model isn't a single model. We've got a range of different data sources: forecasted data, forecasted economic data, calculated forward-looking data, and internal variables and other models that all feed in to give us this overall PD. And then I'm probably, as I mentioned in one of the first slides, that the main input to the ECL calculation is your PD, your EAD, and your LGD. So I'm not going to talk so much about EAD and LGD. They're statistically probably less interesting. Well, the EAD one is certainly much less interesting. It's dubious to call it a model, really. It's kind of a calculation. It basically takes balance and what you estimate your costs and fees and interest will be in the future, but it's a very, very simple model. LGD is not quite so simple, but it's not quite so interesting statistically, really. It's LGD's got two main components, PPD and LGP. So PPD is your probability of possession given that you're in default. LGP is your loss given that you are in possession. So PPD is a fairly simple logistic regression standard scorecard. Your LGP is made of lots of different components that reflects the collections and recovery process that we undergo at Leeds Building Society. None of the components within that are particularly complex statistically. We estimate them primarily using different types of summary statistics. So the LGD model is not statistically as interesting, but in terms of number of components, it's probably more complex. So that's really a sort of whistle-top tour of us just trying to show the sort of how just to calculate expected credit loss over a lifetime, how you can build in a kind of number of different statistical techniques ranging from the really simple to the sort of machine learning space and everything in between. I'd like to just open it up for questions if anyone has any.
Thank you very much. There are some questions. I mean, they can't hear me at home, but if you click onto the Teams account there are some questions in the chat. And don't worry if the screen behind you changed. The screen you're sharing is
Where is it? Where do I go?
I might have to stop sharing to make sure that we take the questions. Right, so we've got quite.
Oh goodness! Wow.
No, it's the transcript. My bad. Yeah, so we've got a few questions in. So I suppose I don't know how you want to do this, but I suppose you could stand here and I can just tell you them. I don't know, or you can read them.
Yeah. I'm not sure I'll manage to get through them all.
For training. Thank you so much for that. I put my questions in there, and then I watch the recording and get the answers to them.
Right. Okay.
Thank you.
Okay. So the first question, what goes into calculating the probability of possession component of LGD? So LTV is the key driver. it depends whether you're in default or not in default at the point of observation, what the other drivers are. If you are in default, there's lots of information about the type of default. So are you in the cure period of the default? Are you a days past due default, so have you hit 3 months down, or are you in default because you had some sort of forbearance activity, those type of things, how long you've been in default, repayment type is a driver as well. So the LTV is the biggest driver of PPD.
Sorry for the audience, just for people who don't know, LTV is loan to value.
Yes, sorry. Thank you, Celine.
Yeah.
I tried to not use any acronyms, but yeah, some slipping. Right. Second question is, the model of models that you've explained sounds extensive. What model or component do you think is still missing from a better supermodel? That's a difficult question to answer, really. I mean, I think there's different ways of doing everything. So I don't think there's like a component missing. There's probably more complex ways or more simple ways that you can estimate any of those components. As I mentioned previously, like the redemption model, we've recently moved from this series of logistic approaches to the random forest approaches. There's always the option of any of the other models using different approaches, but ultimately we still need to predict the same things: the probability of default, the loss given possession. On the LGD, so the loss given default side, we've tried to do is use, where we can, components from the capital suite of models for simplicity, really, and also because for lots of aspects of them, there's no reason why they should be different across the suites of models. Having said that, the PRA are putting a few spanners in that by insisting we do things differently, which may or may not go into IFRS 9, because the IFRS 9 is the better models. The PRA wants us to do things that are maybe not quite as good, so that they may diverge again. But the aim is, where we can, where it makes sense to do so, to have common components across the models.
I'm so sorry. I'm going to ask. PRA stands for, and I can't remember. Is it Prudential?
Regulatory
authority.
Yeah, so part of the Bank of England, essentially, the bane of our lives. Okay, I shouldn't say that, should I? It's going to be on YouTube. Very nice, BRA. Lovely people. Right, okay. How often do you update your random forest model? Well, because we only developed it this last year, we would generally do a sort of biennial review of all the IFRS 9 models. So we do monitoring of the models quarterly, usually. So if there was any indication of lack of performance of the model, we might look to redevelop it. But every 2 years is an absolute minimum. I kind of hope that we wouldn't be redeveloping it in 2 years, that we'd just be looking at it and confirming that it was still okay. I guess it depends if anything really changes. When we developed the random forest model, we used data from about 2015 onwards, because what we found is customer behaviour to market product rates and how often they're willing to change products and change organisations changed really from about that point. So we found the models, when we used more historic data, because what we ideally wanted was to see how they behave in redemption in a downturn, but actually that really wasn't very representative of now. Nothing to do with it being a downturn, but just because of how customer behaviours changed. So if that was to change then in the future, we would then think it's time to redevelop it. What does right, okay, Gary, one of the acronyms I let slip. So that's our econometric model. So its predecessor was called ARRI. So that is arrears roll rates for IFRS 9. And then we had a new generation of models, which is how it became Gary. We had a bit of a late night brainstorm in the office, and once we said Gary, it stuck. So it's essentially an econometric model. So if the runtime of your previous redemption model was the same as the random forest model, which would you use? In terms of accuracy, it is actually very similar. So it wouldn't really matter, but the fact is the runtime isn't the same by any means. The way the previous model was structured with so many series of models, what used to happen is if there's any server blip, it would make it all fall over and we'd have to start again, which is why a model that took 12 hours could take days to run, whereas the chance of your server going down when you're running something for 2 hours is much less. So it's quite fun as well to develop things like random forest models.
Your geeky side, actually.
Yeah.
Great.
I think that's
Brilliant.
Is that all of them?
Yeah,
Yes, fantastic.
I think that's all of them. But yeah, if anyone has any questions, whether here or in the chat, so please feel free to come off mute as well on there.
Oh, and can I just say one more thing?
Yeah.
So if anyone is really excited at the prospect of building this type of model and getting involved in this type of thing, we do have a vacancy at the moment for either a new graduate or someone with a year or two's experience, whether in credit risk or another industry. So just reach out to me if anyone's interested. So we had 3 vacancies, we filled 2 of them, but we still do have one available.
Good. Good. Thanks for that.
Okay, thank you.
So I'm going to take over from Kieran, who had to leave us, but actually what I would suggest we do now is have a short break and then reconvene shortly with Tom for a further chat on climate change risk to credit risk. Is that right?
Credit risk.
Climate change and credit risk. Perfect. So yeah, I'll just put ourselves on mute on this side, and please feel free to have a tea or coffee or whatever. Sorry, I'm looking at the screen, but you're over there. And we'll be back here at I'll suggest 50, 10 to, if that's all right with everyone. Brilliant. Right. Thanks everyone.
Hello, everyone. My name is Tom Clark, and I'm here to talk to you about the challenges of modeling climate change impacts on credit risk. And so hopefully I don't need to give a lot of background on the climate change dimension. Suffice it to say that scientists estimate that global temperature has gone up by 1 degree since the Industrial Revolution, and that if global greenhouse gas emissions continue at the current rate, we're looking at a 4-degree increase in global temperatures by the end of the century. Now, this is going to have potentially fairly serious knock-ons effects to things far beyond just finance industry. So back in 2015, 190 countries got together and they signed the Paris Agreement, which set out a global framework to combating climate change. And a key element of that is to reduce global greenhouse emissions to a level where the level of global warming is limited to 2 degrees above pre-industrial periods, and ideally 1.5%, though that's getting a bit off, 1.5 degrees, so that's feeling a bit optimistic these days. Now, the UK has signed up to this agreement, and in order to achieve these rather ambitious targets, they need to achieve a net zero position by 2050. This is going to require a fairly big impact on our economy. It's going to require changes in a wide range of sectors, industry, manufacturing, agriculture, and of course the finance industry. And the finance industry plays a key role in helping the UK economy, as well as it does within the global economy, of achieving the net zero targets. Now, I'm not going to talk about all of the items on this slide. I like throwing it up here because it just shows all the changes and all the impacts that are going to be required as both the global economy and the UK finance industry shifts towards that net zero target by 2050. It's going to have implications across the board. So things such as how our current solutions and processes around banking, capital calculation, credit risk models, lots of data, new types of data, weather data, precipitation data, data on how we classify different activities in different industrial sectors. There's going to be impacts around sustainable lending as industries look to move away from polluting industries and financing more greener technologies and greener industries. Business strategy is going to have to change. Again, which banks, which companies banks are going to lend to, and the risks around those in lending into industry sectors which are going to be struggling to make those changes and adaptations. And of course, probably the best thing for us and everybody in the room and everybody listening is it's going to require a lot of models. Models around climate risk analytics, models around IFRS 9, models around stress testing, and models supporting regulatory compliance and disclosure. So I'll talk a bit about the UK situation. Probably the most important bit of regulation to come down related to climate change is SS 319, or Supervisory Statement 319 as we call it, which was published by the PRA in 2019 and essentially set some requirements that the finance industry and lenders had to meet by 2021 to deal with climate change. And the fairly basic requirements, but a key aspect of that is that firms are expected to assess and to understand the financial impacts of climate change and to address and oversee those risks within their strategies and their risk appetites. And what that essentially means is lenders have to have an idea of who they're going to lend to, who they aren't, and how they're going to protect their assets and protect their capital throughout the course of climate change under a number of different scenarios. And this is going to involve a shift in mentality, because they're not going to be looking just in the short-term period where most banks tend to look 4 or 5 years ahead. They're going to have to looking into the long-term horizon of decades into the future. A key thing that banks do is stress testing. They test themselves to see whether or not they're resilient to economic risks. And as I say, this always tends to be a short-term scenario. So this is going to be a new concept for banks as they try to get on top of these long-term risks, both on the physical side and what that may mean in terms of changing regulation. And it's this emphasis on long-term scenario analysis, which the PRA is very keen on as part of SS 319. And to support this, last year, they launched the Climate Biennial Exploratory Scenario, or CBES. And this was a test of the resilience of the UK financial system to the physical and transition risks under 3 different climate change scenarios. And it was a heavy focus on long-term scenario modeling. And effectively, it was a prod to the banking industry to actually develop this capability and to start thinking in this these longer-term scenarios and outcomes. Now, the results of the CBES were released of May of this year, and I'll be talking about them at the end of my talk. So for everybody who's just waiting for that, you can switch off now, come back in 20 minutes. For the rest of you, I'll go into a bit of a discussion and introduction on what the CBES requirements, how it affected modeling, the framework that we have foremost developed to deal with that, and go through a bit of a case study example of how it's applied, which hopefully can inspire you guys in your own modeling approaches and some of the things to think about as you're developing climate change, credit risk models, and stress tests. Now, one of the concepts I've touched on briefly, I just mentioned the words physical risks and transition risks are fundamental for understanding how to apply climate change impacts on credit risk. Now, physical risks, when we talk about physical risks, what comes to mind is floods, wildfires, storms. At an extreme in this country, coastal erosion, where your property just literally falls into the ocean. They fall under a category of physical risk called acute physical risk, because they're talking about one-time kind of event-driven aspects. They can cause a lot of damage to a property. They can cause a lot of damage to a factory. They can cause disruption to infrastructure. But there's a second dimension to that, and that's the chronic physical risks as well. These are the longer-term shifts in climate patterns, precipitation, sea level rises, rising mean global temperatures. And they can be as destructive or not, if not more destructive, but they operate on a slower pace. So, for example, changes in precipitation will have knock-on effects on the agriculture industry. And from a lender's perspective, that will have risks coming from rising prices, which mean that a lot of your people may not, your customers may not be able to pay back their credit cards, may not be able to pay their mortgages because food's costing more. It can also affect any loans that you have to farmers or to companies that specialize in agriculture or agricultural products. So again, these chronic physical risks can have much slower moving, but much wider impacts than the acute physical risks people tend to think of when they think of the physical side of climate change. Now, Of course, we're talking about lenders here, so much of the impact for lenders is going to be on the value of assets that they hold and the safety of loans that they have in place. Their insurance industry, it's be completely different talk because they have much more acute impacts from the physical side. Fortunately for banks, insurance companies do tend to take the biggest hit, and the banks are somewhat protected by that. On the transitional side, however, there's a whole new set of risks that banks have to consider. So the transition risks are about the processes and the regulatory changes and the market changes as we move towards a low carbon economy, and what that's going to mean for the value of assets, for any sort of disruption in industry, any sort of risk that flows out of that. So some examples of transition risks are the tightening energy efficiency standards. And one example that's taken place quite recently is, as of 2018, if you have a really badly energy efficient property, you can't rent that out. You have to meet a minimum energy efficiency standard. And a knock-on effect of that has been that first in the buy-to-let market and then throughout the wider residential market is that those properties that cannot meet that target, they have lost value relative to properties that are more energy efficient. And this came out of a Bank of England study that was published about a year ago that looked into that. So this is an example of a transition risk playing out today where regulations and requirements on energy efficiency are having an impact on the value of property. And as a bank, if you have that property as collateral to a loan, that's going to impact those loan to value equations that we were talking about in the previous talk and feed through into your models and the amount of capital and the amount of impairment that you may need to hold. So other examples, rapid technological change. A big one that some of our clients are dealing with is a shift towards electric vehicles. If you have a lot of diesel vehicles, again, if you're lending car loans, you have a lot of diesel vehicles on your portfolio, you're going to be going through a massive reassessment of the value of those vehicles. And again, you could find that they're worth a lot less than you imagined. And again, that means you have to hold more money aside in case those loans go into default. And then there's the other risks as well, as in companies, particularly for corporate lending, who just fail to mitigate or fail to spot or adapt to changes and financial risks due to climate change themselves. For example, being exposed to, say, climate-related litigation. And again, that could impact the market value and any business loans that you may have with those companies. So how does this all flow into something that we can quantify? Because let's face it, we're all in this room because we like quantifying these things. So this slide here just shows you the general pathways of risk. I've talked about the physical risks and transition risks. So flood, storm, and wildfires as physical, regulation, market risk is transitional. And they're going to impact your portfolio at two different levels. At one level, you have what we call local or micro effects. These impact individual individual borrowers, whether they're a person with a mortgage, a person with a credit card, or a person who runs a company. And this has to do with their vulnerability under different climate scenarios. And it could be as simple as their factory being flooded. And as I say, it could be as complex as a collapse of a particular industry with having knock-on effects through the wider economy. On the well, actually, that latter example is the macro side of it. Sorry, I'm jumping ahead of myself. The macro side is the broader picture. These are the macroeconomic effects. So that's the example of the factory in Sunderland that can't shift from diesel to electric, goes bankrupt. Factory closes, factory workers are unemployed, can't pay their mortgages, people who sell them the sandwiches can't make their mortgages, and then you have a wider economic downturn within a particular region. And this can happen at a regional level, it can happen at a national level. And again, it's one of the risks of climate change is that we can see from either transition or physical effects, large-scale macroeconomic effects percolating through the UK economy and the world economy. Now, these all affect banks in different ways, and I put together a listing here the major pathways. So credit risk, which is the main focus of the talks today, basically the need to hold money against losses as your customers' risk of default increases. And that can be against the background expected losses, in which case it would be impairment, or against catastrophic banking effects or economic collapses, which would be our risk-weighted assets or capital. But you also have other risks, such as operational risk, which is literally your bank branch gets flooded. So that's any sort of impact that's going to affect the operations of the banks. I mean, it may sound facetious, a bank office being flooded, but if you have your data warehouse sitting somewhere vulnerable with a lot of high risk of surface water flooding, you could be in trouble of losing a lot of servers, and that could have major impacts as the PRA wonders what the hell you're doing with. with all those servers in a flood zone. Conduct risk. That's actually a potentially serious one, where that's the risk that you could have customers that, because they have vulnerable properties, they could be refused credit. And this can take place, for example, if insurance companies start stepping away from particular products. And a real world current example of conduct risk taking place is to think of the example of people who, because they live in apartments with flammable cladding, they can't sell their apartments. And so what happens in these cases, they're stuck with the same mortgage provider and they have no option to move away, to remortgage. They could be stuck on an unpleasant, very high rate of, so they're paying more over the odds than on another one, simply because they have no option to remortgage away to somebody else. So there's no competition for these people who are essentially mortgage prisoners. And finally, there's business risk, which is basically that the business strategy doesn't adapt to these changes, and the bank or private lender gets in trouble as a result. So, focusing on the credit risk aspect of it. Now, I've got this introductory statement here. Credit risk relates to risk that borrowers cannot repay their loans. Actually, we've had a much more in detail talk about that just before, so I won't go into what the definition of credit risk. But within the credit risk industry, there's a major need for understanding a lot of these impacts, and there's also major changes in how we need to approach them. So the need for understanding obviously comes down to estimating the risk for financial institutions, supporting sustainable business models, supporting the acquisition strategy and the risk appetite, again, who you lend to, anticipating regulatory changes and making sure you're in compliance when those changes come through. You wouldn't believe the scramble that took place last year when CBES came out and people were suddenly trying to figure out how to model climate change. But the challenges are what makes it a very interesting field. And a big part of it is because they require a lot of assumptions about long-term market and economic trends. The CBES exercise looked at out to 2050, and in a particular special case around physical risk, essentially to 2080. And that required a lot of assumptions, first of all, on what that was going to mean in terms of economics, in terms of what was going to happen, how banks were going to react to it, how markets were going to react to it, but also a lot of data and projections about how physical impacts would change over this time, how regulatory impacts would change on that time. And any framework that looks into this has to cover both the climate and regulatory dimensions. It's not enough to just look at flood risk if you're ignoring how the regulator is going to be doing stuff on the other side of things. And probably the biggest challenge is validation, how we approach validation. So within credit risk, we tend to be backwards looking. You look at history and you say, well, this is what happened at the last crash, so we have a pretty good idea this is what's going to happen at the next crash. And that tends to work in economics, because economics is relatively cyclical. Now, of course, if there's any economists listening to this, we can argue that how cyclical it actually is. But generally, when in economics and in these sort of financial things, you can look into a past period and have an idea what's going to happen, at least in the near future, if not the far future. You can't really do that in climate change, because while economics tends to be cyclical, climate change is going up. And so there's no suitable historical period where you can go back and you can validate your models on. And so the emphasis shifts from traditional validation of going back, calculating your R squared, calculating your Gini, and more towards sensitivity analysis, looking at what perturbs the model, what doesn't perturb the model, how likely different scenarios happen to be, weighting by these probabilities, and trying to get a composite picture of what the future may look like to the degree of your ability to make assumptions of the future and, unfortunately, to your computing power. So from a traditional credit risk viewpoint, it's a very different situation. And hopefully, as time goes by, we'll be able to fill in a lot of the gaps, which currently are filled with assumptions. But I'd like to point to this quote by Sarah Breeden in the Financial Stability Strategy, Bank of England. Perfection tomorrow cannot be the enemy of progress today, because 2050 is only 28 years away, which seems like an amazingly short amount of time when you think about all that has to be changed to it. And so a certain amount of guesswork and assumptions is required for the finance industry to know if it is prepared and to be prepared. So that's going more from theoretical into practical here. These are the three scenarios that laid out for the Climate Biennial Exploratory scenario. And these aren't the only scenarios out there. If you go to the Network for Greening the Financial System, they lay out a range of other possible scenarios, some more optimistic, a number of them a lot less optimistic. But these were the three that were chosen by the Bank of England to design the stress tests around. And so because of they've almost become a reference point for any future modeling. Now, I won't go into the exact details. You can all see it up on the screen, but the general gist of it is under the early policy action, the UK and the world starts getting a handle on greenhouse gas emissions, and they start literally tomorrow, whenever tomorrow happens to be, a bit of a moving window there. But the point of it is this activity begins, and so all of the transitional impacts and traditional stresses are moderated. So while there may be some minor reductions in growth and minor increases in prices or drops in property prices, we don't see any major strong economic effects. We do manage to hit that net zero target. It limits the increase in temperatures to 2 degrees or less. And so the physical risk side is relatively moderate as well. Now, the late policy action scenario is the one where we do nothing at all for 10 years. And then suddenly we hit the brakes, do a massive gear shift. And suddenly now we're going to take greenhouse gases seriously. And the result of that is a recession because it's a major shift in industry sectors. We see increases in employment, significant drops in property prices. And this goes on for about 5 years in the residential lending sector. When it comes to commercial lending, more towards close out to 10 years before full recovery. But because we managed to get it, greenhouse gases tamped down, we don't see the massive physical effects. So late policy action really is modeling resilience to the transition risk side of the equation. Now, the no additional action scenario is the opposite side of it. Basically, the world does bugger all. It hits 4 degrees in 100 years, or 3.3 by the end of 2050, and and the physical risks just keep multiplying. So more flooding, more coast erosion, subsidence as well in the UK and across the world. We have wider effects hitting agriculture, hitting wildfires. All the sort of acute and chronic issues I was talking about just become more so. So this is about resilience to the physical side of the equation. Now, I'm going to talk a bit about using physical risk as a case study. Some of you saw this in Edinburgh. Yes, I am kind of rehashing a few things here. But I will stress a lot of this also applies on the transition side, and I'm happy to talk a bit about how you do this on the transition side as well. The key thing is that here in the UK, the major flood risk is going to be flooding, and this is where I live, by the way, taken about 6 years ago. And it comes from three sources. So you have surface water, which this is not, river water, which this definitely is, and tidal surges, which are probably the most destructive of all three. Probably the key element to understand in physical risk is that the government actually has a degree of protection on it. So flood insurance became a major political issue about 15 years ago, after some major flooding that took place, and the insurance industry was threatening to pull out of insuring a lot of high-risk properties. So the government introduced the flood program, and the purpose of the flood program is so that insurers are subsidized to provide flood risk insurance to the highest risk properties. Now, there's 2 catches. It ends in 2039, and it does not protect new builds, as in any property built after 2008. Now, of course, the building industry, in their wisdom, have decided not to. Oh, wait, no, that's wrong. They have built a lot of properties in floodplains since then. So this is actually a major concern for lenders who up until relatively recently hadn't been considering that in the long run, they have booking properties onto their portfolios that could be at significant risk. I should stress that, as I say, this is one of the physical risks. There's a transition element to it. If you're talking about transition risk affecting the UK, it's going to be around energy efficiency, particularly driven by the cost of natural gas and as measured by the EPC certificate. The government uses that as a measure for introducing legislation. It's got ambitious targets. Everyone has an EPC certificate of C by 2050. Not massively convinced that's going to take place without some major rebuilding, but it is behind the drive to put air pumps into people's homes, which the government is now subsidizing for a tune of 5,000 quid, apparently. All good things, but that's the major driver on the other side of the equation. So how does all this kind of become expected losses? Now, the key components of the credit risk model, and this is the highly simplified version from what Joanne presented, is probability of default, loss given default. And to this, we add risk of physical damage. So, for example, if you're talking flood risk, it would be the annual probability of flooding. If we're talking transition risk, it would be how much the property may lose value because it doesn't meet the energy requirements of the day. Properties at risk are going to be there at the middle of this Venn diagram. They're going to be ones that have a combination of high probability of default, a high loss given default, because let's face it, they're only going to be at loss if the sale of the property isn't enough to cover the loan, and if they're at high risk of impact, so say physical damage in this example. So any approach to modeling that only looks at one or two of these equations, for example, if you have a high probability of flooding, but you have a low loss given default, you're not going to have much losses. Again, if a risk of default is quite low, well, let's face it, the bank only takes loss if the property is repossessed. So again, you're not going to have massive impact. So any model really needs to focus on all three dimensions. So this is the general framework that we developed at Foremost for approaching these questions. It's not the only framework out there. There are a lot of people have been scurrying away in their basements developing climate change, but this one works for us and works well for our clients, and is one that we are building on. The key elements of it is in the center of this, you have your PD, your LGD, and then a loss of their capital. So this could essentially be an IFRS 9 model sitting at the heart of it. And this IFRS 9 model would sit within a stress test framework, which basically says, let's go quarterly or yearly into the future, and every year, every quarter, we'll recalculate our IFRS 9 losses, or we'll recalculate our IRB losses, so that's for the capital requirement side of it, using the PDs and LGDs and EAD. But as Joanne said, EAD is really boring. What we did, it is really boring, I'm sorry. So where climate change impacts come in are on impacts to the values of the property on one hand, and on the other hand, onto the probability of default. So property value impacts are going to be from physical risk. They're going to be reductions in the property value because the property could be damaged, or because it's at threat of flooding, and what we call the direct and indirect approaches. On probability of default, this could be things such as if you're at threat of flooding, your insurance bill goes up, and so that's going to be affordability stress. And if we're talking transition risk, think natural gas prices. If you're paying, I think what are they predicting? We're going to be paying £3,000 a month, or sorry, £3,000 a year, but this winter, it's something ridiculously high. But these are the sort of economic shocks that in certain transition scenarios, we see natural gas prices going up quite high, are going to produce, again, be affordability stress on the borrowers. And I should add that actually, property value impacts can feed through not just into the loss given default side, but also into the PD side, because they're also going to change the loan to value. And as the loan to value gets worse, that is, as you get to the point where the value of the property isn't covering the loan anymore, a lot of borrowers get really reluctant about continuing to pay those mortgage. And definitely, if they're the buy-to-let business type, they're going to be out. So I'm going to walk through a general sort of a high-level process of how we would assess the risks, and some of this is quite general to any approach. Some is more specific to our framework, but I think a common first step is just getting the data. So physical risk, this is going to be property level data about what risks are likely to affect it. Now, this picture is a colleague, one of my colleagues who lives in Wales, who volunteered his property to be checked out on the Environment Agency data site. So using Environmental Agency data, you can see he's at a low risk of flooding, not zero, as he'd probably prefer. But that is probably the easiest source for most lenders to get an idea of a starting point for risk assessment. Environment Agency in the UK, well, I should say in England and Wales, not Scotland, provides this data for free. You can get it as a GIS map if you want to, if you're sophisticated enough to put together a program to actually do the plotting for you, and you can go through your portfolio and you can say who's at high, medium, or low risk. But then there's also a lot of flood data specialists who will provide this information for a fee, and to be fair, they're quite good at it. Because they can do projections into the future, which the Environment Agency doesn't do, And they can provide much more detail about likely damages or likely depths of flooding at different levels of risk. Because they've been working with the insurance industry for about 10 years. It's really only the last year or so they've pivoted to start looking into the banking industry. Now, another key thing I mentioned, damages associated with risks. The multicolored handbook, or Handbook for Economic Appraisal, Flood and Coastal Erosion Risk Management, I can remember that. That's why it's on the slide, is kind of the go-to book for estimating these damages. And but there are other sources as well within the insurance industry if there's connections to them. And then of course you need some understanding of how risk and damages are going to evolve over time under different climate scenarios. And again, I'll say on the transition side of it, would be EPC data, which is publicly available. You can download, I think, 50 gigs worth of data sets if you want to link them into your properties. Of EPC information, and from that you can glean a wealth of information about current EPC grade, potential EPC grade, and what they need to do to get there. And the Bank of England conveniently provides, as part of the CBIS exercise, how much it would cost a homeowner on average to upgrade from, say, a level G property, which is the worst, to a level A property, which is the best. Now, I touched on the damage pathways here. There are two basic pathways that we would consider. The one which most people tend to think about is the direct flood risk. So this is the actual physical damage. So again, property gets flooded, and this will be represented as the annual average impacts from background events. On top of this, and to one side of it, you also have the indirect impacts. This is where things get more interesting, but also where more assumptions start coming into it. Because the indirect impacts are where we look at the changes to the perceived market value of property due to the increased awareness of the risk to the property from flooding, for example, but also to such things as increasing insurance costs of the properties, whether the property will or will not be insured into the future, or the risks from accumulating damage from repeated flood events, for example. Now, we typically use cash flow models to evaluate this, looking at average damages, fairly straightforward approaches, but there's a heavy assumption component to it because it's about how the market is going to perceive that risk and how that will evolve with climate change. Now, taking physical risk as a case on it, at the moment, the risk of flood doesn't have a big impact on property values. It's starting to, but it doesn't have a really big one right yet. In the US, where it's a bit of a different system, but also where flooding can be a lot more devastating to properties, we are starting to see it. But to be fair, overall, not a lot of people have actually looked at it. And again, this is something we're seeing changing as more researchers are focusing on what these climate change impacts are going to mean in terms of material impacts to things of interest to lenders. The diagram just shows how it flows together, where you would look at the impacts on the property value, feed it through your credit risk model, and that could be an IFRS 9 model, an RB model, and then look at expected losses. And typically, we would weight up two different expected losses by the probability of the property being flooded in that year or not flooded in that year. And again, there's a default probability component as well, which would adjust that. I mentioned the loan to value. As the property value reduces, the loan to value increases, and that can weaken a customer's willingness to pay. That can require a certain amount of assumptions in there because as of 2008, nobody has offered a 100% or greater loan to value loan, and so that dimension has largely dropped off of people's models. You don't tend to get negative equity as much as you used to. So that does require a certain amount of extrapolation. And again, goes back to the assumptions of extrapolation theme from the beginning. We start having to model things out into the unknown. Direct financial stress is another component that needs to be looked at. So this could be assessing debt to income, estimates of customers' affordability, and linking this to increasing odds of default. And again, assumptions and extrapolation may be required. And of course, things scale in, things phase in. Now, I mentioned that at the moment, we're not seeing a big impact yet of flooding on property values. A big part of that is because some of the most expensive and desirable properties are also the most at risk. Think of that cliffside house with the beautiful views, but yet that cliff is crumbling, or that riverside cottage. Those can be some of the most expensive properties in this country. But we are starting to see signs of it. We did a bit of an internal study ourselves looking at a flooding in Cumbria about how that affected resale values on some of the properties. And we found that affected properties essentially missed a year's worth of house property growth. In the US, we're starting to see more evidence of it. To some degree, people just aren't looking yet, but also it's something that we expect to be low at the moment because awareness is still low. But this is going to change. And a big driver that we see taking place, of course, is the withdrawal of floodry, which I mentioned, which can kick off in 2039. But I think there's also an industry element where when the industry starts becoming more aware of climate change and starts saying, well, actually, we're not going to lend to these people, that the first major lender who does that, first tier 1 or tier 2 bank which does that, is going to start kicking off a set of dominoes, because everyone else is going to start thinking, well, if they're not doing it, either I'm not doing it, or I'm going to start raising the costs of the mortgage rates for these properties to factor the risk element into it. And I think at that point, that's when the ball is really going to start rolling, and we're going to see the full effects of the scaling in of risk. And this can be both on the physical side and can both be on the transition side coming into play. And it's interesting that the CBES actually took this approach on the transition risk. Now, I'll be honest, we spent months trying to figure out how to handle transition risk before the CBES released their guidelines last year. And it was really helpful that they did, because it actually standardized approaches across a wide range of lenders and set a benchmark for approaches. And the key thing in that was that transition risk phases in under their 2 transition scenarios over either between 2021 and 2050 or 2030 and 2050, depending early or late action, hitting the full impact of 2050. And there was another component where certain properties were so badly energy inefficient, they reduced down to land value. You literally bulldoze them over, use the planning permission, and build a new one up. So these were all phased-in effects. And essentially, we've taken the same approach to the physical side of it. Market's going to change. And so instead of applying all these effects on day one or waiting until 2050, we phase them in over time. So I'm going to present a rather stylized case study. It's not based on any one client. It's actually aggregated together from all 7 of the clients we've built these models for. So don't worry for anyone in the room. I'm not showing your results. So the basic assumptions on this is, and we'll focus on the flood risk element. Market impact of flood risk initially small, but increases rapidly as 2039 approaches. And we're using the highest scenario for flood risk. So we start with the direct impacts. They're there. They increase slowly up to 2050, but they're not massively high, though. And the reason for that is actually flood is relatively rare event. Even the worst affected properties may only have a 4 to 5% chance of being flooded in any given year. But then we start putting in the market impacts, that indirect risk, and now we see the losses increasing because the threat of flooding, the extra insurance cost, is now percolating through the market, and a lot of properties are starting to lose value as a result. So these start coming in, and they dominate the actual impacts of actual direct flooding. But these losses are sensitive to market assumptions. All right. Now, but so far, this is the basics of it, but we haven't considered a special class of properties, and those are the ones that are going to be completely wiped out. Think the house on the cliff, the property that's flooded so often that no insurance agency is going to touch it, or on the transition risk side, so energy efficient that all anyone can think to do is bulldoze it and build a new house on it. They're going to lose a massive amount of their value. That's the extreme end. And here we are. They account for the vast majority of the losses. Not surprisingly, because they have that magic combination of a really high low LGD, because the property value has tanked, massive PD, because who wants to keep paying a mortgage on a nearly worthless property, and their value, and that really high risk of whatever the impact happens to be. They are the high risk properties. But I should caution that these are also the ones where the most assumptions are on, because they depend heavily on market assumptions and regulatory assumptions on what's going to take place in the future. And so you can stick a bracket on this. It could be higher than that, it could be lower than that. This is where the uncertainty in a lot of the modeling resides. So what does that mean for the CBES? Now, the CBES published the results in May of this year, and not surprisingly, they found, well, first of all, they found that actually the financial industry is relatively resilient, but it's going to be a drag on profitability. Of all the things we're worried about climate change, a drag on profitability. But the overall cost will be lowest with an early, well-managed transition to a low greenhouse gas economy, not surprisingly. What they found is that under the late action scenario, losses are going to still be fairly significant. So across the average of all the banks that took part of the CBES and reported results, looking at 160% increase in extra losses above the baseline for the financial sector, and only slightly higher under the no additional action. So what essentially saying is that if nothing is done at all, it's going to be bad. If nothing is done for 10 years, it's only going to be slightly better. The drivers are different. Physical damage on one side, economic shock from a mid-year, a mid-period recession on the other. But overall, the finance industry will survive this, but they will need to be prepared and need to make changes in strategy. You can argue how much I believe these results, and keep in mind there's a huge amount of variation across the various CBS participants in terms of the extremes. And I'll be absolutely honest, I think the economics on the no additional action were really overly mild. I think things would be a lot worse on a more macroeconomic front. That's me. But it does highlight the CBS's view on the risk of the lending industry. So what is that going to mean? From a modeling perspective, I think it's going to be a convergence of methodologies. This has been a starting point. There's a lot of different approaches, and I think everyone's looking around to see what everyone else did. We certainly are doing that, and we're trying to figure out how we can do it better, what assumptions other people are made, and try to stabilize around a common set of assumptions. And I would be very, very surprised if Bank of England doesn't take a major role in this, because they like to see standardized outputs. As they said, for one example, against one counterparty, they found a tenfold difference in estimates of the losses attached to that particular counterparty from two different lenders. More requirements for climate risk and calculations for provisioning and capital requirements. Bank of England is hinting towards that, though they're being really cagey on what will be required. And certainly there's some massive challenges because capital requirements, the whole IRB system, apologies for those who aren't very familiar with it, is designed for systemic but major capital crash, economic crashes. It was never designed around something where the risks keep going up, such as climate change. Greater focus on completeness and coverage of climate data. So basically more data, more information provided, and data provided upfront so banks can make those lending decisions at the point of offering the mortgage, not a year later trying to figure out what the damage is going to be. And hopefully fewer assumptions as more and more research out there. And I depend a lot on this, on reading a lot of external research that Bank of England has done, that research that different universities have done to pull in a lot of these assumptions. And as more of this research comes out and is published and there's more focus on this, hopefully fewer assumptions and more facts built into these models. I'm just going to end with a plug for our company. We are hiring, yes. We offer graduate opportunities, internship opportunities. It's both in credit risk, and we also cover insurance for anybody in the insurance industry looking. Really great company to work with. So check us out, and I'm happy to pass on the information. And there's some links there. In case you don't get a chance just to scribble it down, I'll happily pass that on. Thank you. Any questions? And yeah, I might need some help in figuring out how to do that bit.
Thank you very much for this.
I don't want to accidentally,
No, it's all right. I'll come in and try and share the right thing. Brilliant. So we haven't got any questions in the chat at the minute. Has anyone got any questions, whether in the room, or please do feel free to put it in the chat or to ask your question. Come off mute if you want to. Has anyone got any?
Yeah.
So, very interesting to see what you're doing. But you mentioned that economic behaviour is somewhat cyclical, and that we can predict that better, and that we're struggle with climate in terms of predicting. Now, here these and other research groups around the country, well, and the globe actually, that there's a big focus on simulations for past climates, and then how to use that to guide views on how they could. And we've seen that in previous inflation periods that there are similarities with what we've seen in the past. opposed to the evolution. So I was wondering sort of what your views were on this and how we can actually use this information to make better.
Well, I agree 100% on the climate modeling per se, and you know, I did do a lot of looking into that and how that's approached in the lead up to a lot of the work we were doing on this. When I'm talking about the cyclicity and the predictions, I'm talking purely about the economic side of it, and the difficulties around. So for example, when banks are building models such as the IRB model, which is designed to say we're going to set aside a big chunk of cash in case there's a major economic crash, the PRA requires that they look all the way back to the crash in 1990 to understand how much capital they need to hold and to be able to build assumptions and information and behaviors going all the way back there into the models. Now, how cyclical economic crashes are is a whole argument. I'm not an economist, I'm a biologist actually, so they don't look massively cyclical to me, but they do tend to happen, you know, every 20 or so years. There are differences between them, but at least it gives from a finance and economic point of view, a reference point to say that, well, we had a crash then, we saw this happen, we have another crash in 2008, so people did this. And yeah, okay, one so you know, was quite different from the other, but it gives them at least a reference point for doing this. The problem with climate change, from modeling the climate change and what that's going to do in terms of physical risk, you're spot on. And actually, a lot of the modeling that's done to produce the flood forecast is based on just those sort of historical modelings and projections, and looking forward into how those are, you know, how temperature is going to change, how precipitation is going to change, how that's going to change, local precipitation, how that's going to work with local geography to create flooding. The the bit that they struggle with is going to be, what's that mean for lending? Because obviously people weren't lending you, 20 mammoth tusks for, in exchange for this glacier. So there's not really a reference point for that. Most of the climate change effects have been building up slowly. I remember it first being mentioned back in in the 1980s when I was, a young biologist. And back then, half the people still thought it wasn't going to happen and had no idea. Even between now and then, we're starting to see the effects coming on. We can't really look back to 1980 and say, well, what happened there? Because the effects at that point were so small, they didn't even register on the finance industry. Now we're starting to see effects. And I'm sure 20 years from now, if nothing gets done, somebody's going to be looking back at what was done here and say, well, we saw this stuff taking place in 2022. Can we extrapolate it to what's going to happen in 2062 from where I am in 2042? But we're not quite there yet, because obviously it's not 2042. And so there's nothing economically, there's no useful economic historical data, because all the economic data and financial data is overwhelmed by a lot of the background, just regular economic cyclicity. And we're only now getting to the point where the climate change effects are cresting out of that background wave and starting to have the strong effects that we're observing. And unfortunately, that's why we focus heavily on sensitivity analysis, on assumptions. We can put probability around these assumptions, but we can't do the traditional validating of look back 10, 20 years and say, well, this is what's happened then, that crash, so this is what is likely to happen in the next crash.
Thank you.
Any other questions?
I don't think there's any on the chat. I can't see any, but I do have one if that's all right.
Okay. Yeah, no worries.
I just want to ask actually. So, in terms of your suggestion, then is it to actually input a lot of, because I think what you've said is actually you've suggested flooding is one of the examples. But how would you plan? And what would your view be on kind of integrating all of the different climate change rates? Because obviously there's so many different ones and they interrelate. They correlate to each other often as well. So how do you think that's going to be approached in modelling?
More complexity mostly. So we have just thinking about the physical risks. It does raise its head a bit, because you can have flood risk, you can have subsidence risk together on the same property, for example. So there are ways of running different direct and indirect pathways, for example, or looking at certain impacts. So transition risk tends to be something that we do, off the top before we even deal with physical risk, or you can flip those around. The tricky bit is where they start intersecting and combining with each other. Now, I think we're kind of lucky, I want to call it luck, in that flood risk tends to be quite overwhelming, and subsidence risk is more an issue for the insurance industry than it is for the banking industry, because subsidence is relatively rare. Well, it's not good when it happens to you. It's relatively repairable compared to flood risk, which has much higher damage potential and much more common. It's just that a lot of more properties are at risk of subsidence. So we don't tend to have to deal with that intersectionality. It would be different, for example, in some place like Sydney, where you have to deal with wildfires during the summer, and as they're doing now, massive flooding during the winter, and then have to factor those two risks together. So I think there's going to be in certain locations more of intersectionality around how to combine these different risks together and to deal with that. For now, it's not something we really had to deal with, except in the rather blunter tool of, property can have transition impacts, can have physical impacts, but because they're kind of isolated, you can almost just add the effects on top of each other.
Thank you.
Okay. All right.
Any other questions?
Please feel
free to ask.
Okay.
Well, thank you, and thank you both, Tom and Joanne, for these talks. It was really, really good and really interesting. I think what we're going to do then is suggest that we close the talk online. Sorry, apologies, but we can't easily have a chat at the end online. But thank you everyone for attending. The recording will be shared after the session, so feel free to have a look at that if you're interested, and we will be happy to share the links. In fact, I'll share the links with everyone who attended as well on by email afterwards, especially for the ones interested in the job openings, which they are in both cases. So thank you everyone, and have a lovely rest of your day or evening.